Hey everyone, Mortgage Nerd here. Want to give you a rate update, but I want you to understand that this is the type of thing that you don't get from most people in my business. In the mortgage business, you have advisors and you have order takers. Most people out there are order takers. Very few are actually advisors, people that can understand what goes on with your mortgage, that understand amortization schedules, that understand rate charts, what drives an interest rate. When the Fed comes out and says rates are going down, mortgage people are like, the rates are going down. No, that's completely different. Two different things. So let's talk about mortgage bonds. Mortgage bonds work inversely to rates, meaning as a mortgage bond goes up, the mortgage rate goes down. The 10-year treasury also drives interest rates. The 10-year treasury, as that goes up, mortgage rates follow it, they go up. So mortgage bonds are opposite. 10-year treasury moves in the same direction as the rates typically. So let's look at the charts. Let's see what the heck I'm talking about. All right, so these are the mortgage bonds, and right now we're up 27 basis points. That's a big move in one day. Not as big as last March when the market was crashing and things were going, 90 basis points in a day. It was insane. 10-year treasury going down. So remember, when this is going up, rates are going down. When this is going down, rates are going down. These are other mortgage bonds. So there's different coupons. This is a 1.5, a 2.5. We were using 2.5 recently, but now that rates went down again, we're in the 2% coupon. This is Ginnie Mae. So this is VA loans, FHA loans, and so on. So today's a good day. But let's look at overall. I mean, I have clients that they call me and they're like, oh my gosh, I'm so worried that rates are gonna go up. I say, I don't know who you're talking to. They're probably being scared by these call center people that are saying, hurry up and lock your rate because they're low right now and it's only gonna go up. It's because they don't know what the heck they're doing and they're just locking in just in case. They're throwing it against the wall to see what works, to see what sticks. But as you can see here, look at this trend line for the mortgage bonds. It's up, upward trend line. And yeah, okay, there are times that it's come down, but I'm not locking people down here. I'm locking people up here. And then a couple days ago, I'm locking people up here. So Monday was really nice, really nice. Today's Thursday. So this was Monday, Tuesday, then yesterday, it started tanking, but I locked in a bunch of people at these two because I look at other things. I look at, all right, what the heck is this line at an angle and then there's this straight line here. Well, this straight line, you see the percentage there is a Fibonacci level, Fibonacci retracement levels. So Fibonacci is a guy who found this thing and created it and said it's his, where it's all percentages that you can see in anything. You see these percentages, this calculation in architecture, you see it in math, you see it everywhere. And so we see it a lot in charts, whether you're looking at stocks and bonds, whether you're looking at cryptocurrency, whether you're looking at mortgages. We follow the Fibonacci retracement levels and their levels of resistance. So if it comes up to one of those lines, it might hit it like a roof and then come back down. If it breaks through, that's a good thing. If it's going the wrong direction, it's a bad thing. It all depends on what your point of view is at that moment. But then there could be more levels of resistance, like that slanted line is a moving day average. So that moving day average is it's just that. It's an average of all the days put together depending on what that calculation is. So let's go back and look. So this 200 moving day average right there means that over the last 200 days, that's the average. Then we have the 100 and then we have the 50. As you see, the 50 and 100 crossed back because it's going up. That's good. So hopefully now the 200 flattens and starts going up also. But either way, these two lines together are resistance. Look how it stops right there. Let me zoom in. Look at that. These are wicks and these are candles. So the candle went all the way up that day. It broke through the two levels and looked great on Tuesday. Then it came back down. And where did it end the day? That's one of the most important parts, is where does it end the day when you close the candle? And it ended right on that moving day average. How strong is that moving day average? So when we come back up to test it in the coming days, we're gonna get into this area here. It's gonna be kind of a do or die. Are we gonna move up and stay above it? Are we gonna move down and stay in this range over here? It'll be interesting to see. But either way, the trend is our friend, and the trend is that rates are going down very, very slowly. Over a 2 or 3 week period of an underwrite for a client, we might get a rate drop from a 3.125 to a 2.999, which is the same as 3%. Just looks a lot better. You know, that's what we've been seeing. It doesn't mean that in a week we're going to go from 2.999 to 2.5. That might happen. But right now the trend is our friend and it's going down, so I always urge everyone to get in process, get your mortgage going, and then I will lock you at that right time when it's time to close, and we've got you in there. So now we're back at the charts, but we're looking at the 10-year Treasury. 10-year Treasury is down today, which is good. It's good. Yesterday it actually jumped up quite a bit, but again, we had a huge drop on Monday, which is great. Remember the resistance levels I'm talking about. This resistance level right here, look how many times we came and tested it and then boom, broke through Monday big time. Why? What happened Monday? Stocks tanked. Stocks tanked, especially travel stocks, because of the Delta variant of COVID. This might be the first of many that we see with all the fears of the Delta variant. And so this drop in 10-year Treasury was really good. And we ended under this level of resistance, but it didn't hold because the next day we came down, but in the middle of the day on Tuesday, we came back up. That was telling me that we need to lock. That we're not going to wait for the next day where on the next day there was a locking bias and we got an alert to lock. But I had already locked the people that I needed to lock. I wasn't waiting on anyone else. People that aren't closing for a month, I haven't locked them because I think maybe we'll get a little bit of a better rate in there for them. Then we see here today we're moving back down, so this might be our new range, which I'm really happy with. So this is where we are in rates, and I really hope that this explanation helped go more in depth with what I see and what I do and my expertise in mortgages. I've been doing this for years, and I do it in other things that I invest in, like, you know, crypto, and I actually leave my stocks to my stockbroker. You know, but crypto's kind of cool and new, and there aren't crypto brokers, so that's my technical analysis that I do myself on those investments. And that's pretty much it. Phil Stevenson, Mortgage Nerd. Thank you. Guys, that's enough. Get the out of here.